Good morning, students. Today we are going to do the next chapter, that is financial management. In this, we are going to study, and basically we are going to revise it again. Financial management basically is concerned with allocation, acquisition, and usage of funds. That is the first basic thing which we have to understand. And this is being done to reduce the expenses involved while procuring the funds or controlling the risk involved in the funds which we have procured, so that they are being used to the maximum extent and we get the required productivity. And we have understood the word financial management. Management is basically managing men at work. Now we are not managing men at work, but here we are managing the finance which we are going to raise from the market and use it for the growth and development of the business. So, how we are going to raise the funds from the market, they are dependent upon various aspects. Okay, on various elements which are involved in a business. On that basis, we are going to raise the funds from the market, okay, and then manage them for the development and growth of the business. Now, what are those important areas which are being taken into consideration before raising funds from the market? Is first the size and the composition of the fixed assets. Okay, the this explains that the what is the total amount of money which we have invested into the fixed assets. Okay, what is the investment being done by our business? Okay, and how much of the total fund which we are going to raise from the market will be utilized for fixed purposes, long-term investment purposes. Okay, because the money once invested into fixed assets cannot be recovered back. That is an irrecoverable decision, and if the decision regarding investment goes wrong, then it will cause big loss to the business organization. So, first thing which we are going to understand is that how much of that money which we are going to raise from the market is used for the fixed assets purpose, okay, or for the investment decision purpose. First thing. Second thing is that amount and composition of current assets. So the another important thing is that how much of the money which we are going to raise or which we have raised from the market is being used for the purpose of short-term financing or for the purpose of working capital. Okay, because that this part of the capital is being kept in the form of liquid assets in the organization and is used for running the organizational activities on daily basis. Okay. Now, how much of the current assets or the money is to be maintained in the form of current assets, i.e., liquid money, depends upon the amount invested in fixed assets or amount invested in your stocks, matlab inventory, and how much of the credit you have given to the business organization, means to the suppliers, to the customer, sorry, for carrying out, or how much business is, how much of the credit is available to your business and how much of the credit is being given by your business. That these are the three basic areas which are going to decide the amount of money which has to be maintained in the form of current assets. Okay, another is an aspect is which decides that how much of the money is being used for fixed or current assets is the long term and short term funds, the amount. Okay. The quantum is, because financial management has because since we are going to manage the financial resources, so it is very important that we need to understand how much of the funds will be required in future for the long term purposes and for the short term purposes. Okay, so okay, so here it is being said that the firm requires more of the liquid assets. Okay, and when even when the profits will decrease, okay, a firm requires more liquid, then it will prefer a long-term finance even when the profit will decrease due to payment of more interest in comparison to short-term debts. Okay, so it wants to say that if the business want to become stable, they will expand into the long term assets so that the production capacities can be increased and that can be used for the future aspects rather than just focusing on the current position. So the amount of long-term funds, how much of the long-term funds and the amount of the short-term funds is required, that has to be taken into consideration while carrying out the financial management. Then another is the proportion of debt and equity in the capital. Financial management, before in financial management, we are also going to understand how much of the money is to be used in the form of equity capital. Another is the debt to capital. Equity capital does not carry any short-term liability, but it is a permanent liability on the organization, whereas a debt capital carries a burden of interest and is a short to mid-term liability, mid-term to long-term liability. And here you have to pay the principal amount along with interest within a specified time period. So it is very important while raising the funds from the market that how much of the debt capital and how much of the equity capital we are going to use for the purpose of financing the business proposition. Okay, and the last important thing which is there is that how much of the profit and losses are there. Okay, if profit and loss is being earned by the business, okay, it will like if you have raised more of the debt, then you have more of the interest liability, which will affect your profitability. Okay, if you have raised more of the equity, then it is not compulsory to pay dividend. So this composition of the funds is going to ultimately impact the profit and loss position, and this impact on profit and loss proposition is also being taken into consideration while deciding the source from where the funds are to be raised and how much and when is to be raised, so that the profit and losses are not impacted to the major level. That is the another important aspect which is being taken into consideration while doing the financial management. Okay. Now, the another important aspect is the objectives of financial management. Financial management is basically done to first thing is to maximize the wealth of the shareholders. Maximization of the wealth of the shareholder means that it is not only increasing the profitability of the company, or it is not distributing money amongst the employees, but also it is helping the shareholders to have a better market valuation, because of which they feel satisfied and stay invested into the company. So that is the first basic thing why financial management is required. That when the funds are being properly used in various projects, when the funds are being properly raised and they are helping in earning a better rate of return, that is increasing the market goodwill of the company, which in turn is converted into the higher prices of the investment which is being done in the stock market. So this is what the stock where the wealth maximization of shareholders is there, that the shareholders feel satisfied, they are getting dividend from time to time, they are watching that profits of the company are growing, and ultimately their investment which they have done in the business is safe and secure and is growing on regular basis. That is what the wealth maximization of the shareholders. So financial management is done to help the shareholders generate higher valuation of their investment. First thing. Second thing is that it helps in taking appropriate financial decision, means how much to raise the fund at what time and from what source, so that valuation of the investment of the shareholders does not get impacted. That is the another important reason, another important objective of the financial management. Third is that it leads to optimum utilization of the funds. Maximum productivity is being generated out of the funds which are being raised from the market, and it provides sufficient. It helps in creating sufficient amount of liquidity of the stocks, liquidity in the company, so that the company does not have to look for money again and again from various other sources. So that is what the financial management is doing, that it is not only increasing the profitability of the company, but also it is helping in maintaining appropriate amount of liquidity, so that the working capital requirements of the business are not being impacted. Okay. Then another is, it is helping in choosing the best alternative for the business organization as to from where the funds are to be raised and how much to be raised, so that optimum utilization of the funds can be done. Now, there are three types of decisions in financial management. First decision is investment decision, another is financing decision, and third one is the dividend decision. Investment decision is a decision where we decide where to invest so that we can generate maximum returns from the investment which we have done for short term and long term. Okay. Now, in long-term decision, we have to see various things. In a long-term investment decision, we are investing huge amount of money in the fixed assets like machinery or land. Okay, these decisions are also known as a capital budgeting decision, and these decisions have long-term impact on the profitability of the business also, because they involve large amount of money and they are irreversible in nature, and they are they lead to addition of risk in the business also. For example, when we buy some we start some construction of new building. Okay, if the time when we have started construction was a boom period, but suddenly the slowness enters into the market, then we are going to suffer the losses on that particular project. So that is what we say, that is how we say that these types of projects are riskier in nature, because they involve huge amount of money. First thing. Secondly, they are being invested for a longer time period. Thirdly, they decreases the liquidity in the system, and another is their impacts can be on the other business propositions which we have which we have been carrying on, and so those another aspects of business can also get impacted because of the investment decisions. So while taking investment decision, we need to be very we need to be very careful that they are not going to impact the other businesses which we have been already carrying on. Okay. Then short-term investment decisions are the decisions which are related to working capital. Working capital basically, sorry, working capital decision has to be taken because it helps in maintaining liquidity and creating liquidity and helping in establishing profitability of the business. Because if the cash management is not done or inventory management is not done, it can lead to misappropriation of the funds or misappropriation of the stock which is lying with the business, and also or the productivity and efficiency of the business will get impacted. So, in order to avoid that, we need to take appropriate decisions with regard to arrangement of working capital in the business, so that we have sufficient liquidity available which can be used for generating enough of the profitability in the business. Okay, so that is what the working capital decisions are. Then we have the factors affecting. Now, what are those factors which affect the capital budgeting or long-term decisions? First is the cash flow of the project. If the cash flows of the projects are good, then we should try to take up the new projects. Mean cash inflow is more than cash outflows, then we should try to take the new investment decision, because that will not create extraordinary burden on the business, since business is already in a good financial condition where it is generating sufficient amount of inflows of the cash to repay the interest liabilities or repay the principal amount liabilities which would arise because of the new projects which we have taken up. Okay. Then another is the rate of return. We should take into consideration that how much is the return on investment which we are going to do. If return on investment is comparatively better than rate of interest which we are going to pay on the money being raised from the market, and then it is a advisable option. Otherwise, we need to abandon such type of product where rate of return is less or comparatively quite is not in a comfortable position where we can't cover up our permanent liabilities. So it is very important to understand that how much of the return on investment will be from a particular project. Supposing if you are paying rate of interest at the rate of 10%, but the return on investment is approximately 12 or 15%, then we should go for a project which will generate us for us a 15% rate of interest than 12% rate of interest, because the costs which the other costs which are involved will leave us with uh, 3 to 4% of margin that will be sufficient enough to pay off the liabilities for that particular project. Then another important thing is the degree of risk involved. If the risk involved in business, supposedly we are raising rate of interest of 15 or 18%, we are being provided, but the risk involved is quite high comparative to the proposition where return on investment is 12 to 13%, then we should undertake that risk proposition also, and should choose the project with lesser rate of return on investment, because the risk involved in the other project is quite high and can cause serious losses. So that is the another important consideration while taking the investment decision. Okay, so first thing is cash inflow position. Second thing is the return on investment, and third thing is that we need to undertake is the degree of risk involved in the project. Okay. So these are the some of the aspects, and the investment technique is that what techniques, capital budgeting techniques are being used for calculating the rate of interest on the cash flow position of the project, and that also decides what type of investment decision we are going to undertake. So these are the some of the aspects which we will undertake while taking any investment decision. This is all for this particular lecture. Then we will go for financial decisions in the next lecture. Thanks.